Good morning and welcome to the show. Hope you're all well. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks under pressure while U.S. futures drop on worsening trade tensions. Nvidia flagging new U.S. curbs on its chip exports to China, and President Trump looking into potential tariffs on critical minerals.
Now, Trump is also challenging China to pick up the phone, but a former top official tells Bloomberg that Beijing will only talk if Washington shows respect.
And we'll have more on the trade war ahead as well. China ordering its airlines not to take further deliveries of Boeing jets and aircraft parts from U.S. companies. Well, happy Wednesday to everyone. Happy hump day, of course. But really, when I take a look at what's just happening on the screen here, you can see sort of the major theme that's developing in the session so far. And this is very much focused on tech. We had some export restrictions being announced in the last couple of hours. So essentially, and I won't get into all the details, but Nvidia is going to be further restricted from selling its products to China. Essentially, this is the H20 chip. It was specifically designed for the mainland market. But you can see here, as we get trading in Taiwan underway, it is leading the decline so far. Even though we do see broadly Asian equities and US futures under pressure, the dollar, again, a bit in the red this morning. So let's actually take a look at some of those names in particular. TSMC, for instance, is the most exposed to this Nvidia story. And already you can see here at the open, it is under pressure somewhat. These losses that we're seeing so far, they're actually not to the same magnitude that we had for Nvidia after hours, which had slumped around 6%. But certainly we will be watching these names as they go through today. Invesco, for instance, is highlighting this is going to have a really big bearing on some of these names. Nvidia already flagging a $5.5 billion hit within the next few months. But let's also take a look at the Golden Dragon Index overnight. Actually, it was another session kind of sideways trading, a little bit under pressure into the close. What I do want to highlight, though, is a very interesting view that's we're going to discuss essentially later this hour with Qin Zhilao. He is the chief China equity strategist at Goldman Sachs. But he's saying that when he's speaking with investors, a lot are talking about this risk of Chinese companies being forced to delist from the US. So we'll dig into that with him. And also taking a look at how Chinese futures are setting up as well ahead of the open this morning. We do see them looking, again, a bit under pressure so far. Really big countdown as well, Dave. Okay, maybe it's a little bit backward looking, but we do have the monthly activity figures and the GDP numbers coming up.
Yeah, and I think that's going to give us, I think for one, a sense of directional momentum here in the economy. While Bill was pointing out, the world is vastly different from what it was in the first quarter. It will give us a sense of sort of directional trade, tactical trades if you're, of course, an investor and trader in this market. I think number two is to what extent within the GDP print, exports did make up as far as growth is concerned in the first quarter, and how much of that was front loading, how much then, and this is the forward-looking question, how much then does the consumer need to pick up to offset any absence in net export growth moving forward because of the front loading that took place, I think. And anyway, we'll get to all of that later. Plus, of course, home prices are due out at the bottom of the hour, so 21 straight months of home price slump. It's certainly abated somewhat in terms of magnitude of late, so we'll get a sense of trend there as well. And sectors to watch, as Bell was pointing out, so gold obviously record high. You have airlines on the back of, again, the corporate iteration of the strategic rivalry in terms of the Boeing story in China Southern, and of course chips on the back of the Nvidia story. Right. Now, on that very note, let's have a look very, very quickly at some of the projections here as far as the data is concerned. And, of course, in about an hour's time, we will be obsessing over backward-looking data. Why not? That's what we do sometimes here. 5.2% is the forecast. The range is from the high 4s all the way to about 5.3, 5.4. So keep an eye on that. Anyway, all of that coming through in a moment. But let's get it back to the here and now and perhaps what's more indicative of future direction here.
President Trump is probably indicative of future direction, but he has called on China to reach out to him to start negotiations on resolving their escalating trade fight. The latest comments from the White House came as Beijing ordered airlines not to take further deliveries of Boeing jets and US-made airline parts.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
Meanwhile, you have a former senior Chinese fiscal official talking about Beijing will only engage in talks with the U.S. if the White House shows some respect. You have the ex-Deputy Finance Minister Guangyao speaking exclusively to Bloomberg. Have a look.
U.S. wants China totally accept the U.S. proposal. To accept the U.S. conditionality, I think there's no negotiation. And must be under the mutual respect and with this joint win-win situation.
Let's bring in Jill Desis, our Bloomberg News desk editor, to get us to the latest here. So, Jill, the U.S. president says, pick up the phone. Call me.
Well, I mean, here, David, I think you're just stuck in this game of chicken between the world's two largest economies, right? I mean, you look at, I think the big takeaway here is that we're not engaged in high-level talks. We're not seeing high-level talks between the U.S. and Beijing right now. There doesn't really seem to be a whole lot of movement then. I mean, we've just spent the last 2 weeks watching these two countries ratchet up tariffs on each other to the point where China last week, once that big, 125 or 145% tariff, however you want to look at it based on, other tariffs you're calculating, once that went into effect, you had China just say, we're ignoring future tariffs because at this point it's, just kind of pointless. There's not really much more to move here. Meanwhile, obviously, you've got this Boeing news out of China. You're seeing a lot of these tensions escalate in different ways. You've got Trump now talking about he's directed his Commerce Department to mull potential restrictions on critical minerals, tariffs on critical minerals, of which China really, exports some 70% of rare earths minerals there. So, I mean, you're looking at this, ever-evolving trade war between these two countries that doesn't really seem like we're actually moving towards something actionable in terms of discussions. I mean, obviously some, thought here that what the Trump administration is trying to do is, bring together its other trading partners, get some of those other, reciprocal tariffs on their allies really resolved first, and then maybe kind of use that as a way to pressure China into pressure them into making some concessions that impact China. But again, I think all of this just shows you that there's still a whole lot of daylight between the U.S. and China on this right now.
And I think we sort of just heard it alluded to there in the soundbite from the White House press secretary, but talking about China wants what the US has, or that's the perspective of the Trump administration. And I know the Wall Street Journal as well has been writing about this, saying that the US is essentially looking at using these negotiations to try and isolate China. But what do we know on that front, and what's the strategy, I guess? Yeah, I mean, so, the thinking there is essentially, the US already has, the 90-day limit to kind of, go to talk to its other trading partners about these reciprocal tariffs that, it dropped on the rest of the world, then delayed. It still wants to go to the table with places like, the EU, like Japan, like Korea, and actually figure out some kind of an arrangement that maybe, creates more favorable trading conditions for the United States. I think the strategy there that the Wall Street Journal is kind of alluding to is this idea that, okay, well, in those types of discussions, the U.S. can sort of pressure some of its key allies to, sort of further restrictions on China. I mean, to be fair, we did see this during the Biden administration, for example. I mean, we've seen the U.S. in several occasions, particularly when it comes to things like semiconductors and advanced chips and such, really kind of lean on its allies to try to restrict trade with China. Continue those sorts of things. I think, maybe that's what the U.S. is looking like here. But again, I mean, this all just brings us back to the fact that we're in a really, really, really complex, fraught, tense trade, situation right now, where you've got all of these tariffs, not just on China, but also the threat of tariffs on a lot of key allies with the United States. You've also obviously got all of this chat about sectoral tariffs, including those on, critical minerals, including, some of the semiconductor talk, pharmaceutical talk. So it really just shows us that, maybe there is a strategy there by the United States, but, things do seem overall very, very fraught right now. Yeah, I think that's very fraught is maybe an understatement, but let's see. That was our Asia News Desk editor Jill Deesis there, and of course one of the areas that's been caught in the crosshairs this morning, at least, is Nvidia, and we've seen further restrictions to China essentially with the H20 chip, and we saw that big drop in after hours. We're seeing the chip makers under pressure this morning so far. TSMC, for instance, is off today around I think more than 1% at this stage, not quite the brunt of what you see there, but still. Let's get more now with our China correspondent, Min Min Lo. So, Min Min, talk us through these restrictions, where they came from, the timeline.
Yeah, so the White House told Nvidia that its H20 chips will now require export licenses to be sold to China. And these are the scaled-back version of the chips that were designed specifically for the Chinese markets in order to meet the pre-existing restrictions under the Biden administration. And they had been a cash cow for Nvidia, estimated to have brought in $12 to $15 billion last year. And this year, because of the anticipated tariffs, Chinese companies have been front-loading orders, according to the information, ordering $16 billion in the first quarter alone. And so Nvidia is saying that this new rule will mean that they will have about $5.5 billion of charges related to inventory and purchase commitments. And that's why we are seeing the big drop to the company stocks in the after-hours trading. And if you look at some of the suppliers to Nvidia as well, a big drop across the board to some of these stocks that are trading in Hong Kong, in Taiwan and South Korea as well. And MLive's Mark Cranfield was saying that the Hang Seng Tech could be bracing for a very tough morning, just given how Wall Street had been performing. The Nasdaq futures also trading down this morning. And as Jill said, one of the ways to isolate China, the White House saying that the H20 chips, even though they are scaled down, they are still too advanced and could be used in supercomputers in China.
Min Min. Thank you so much. Min Min Lo, our China correspondent there. Right. So, all of the stories we talked about here. So you have the trade war. You have the Nvidia story, and of course you have Malaysia. Before we bring in our reporter David Huang, I just want to show you the front page of the South China Morning Post has the various iterations of the trade war. Front page, you have Xiao Baolong, the Chinese representative, of course, who oversees Hong Kong here, talking about hitting out at the U.S. You have, of course, this picture of President Xi Jinping arriving in Malaysia. That's number 2. You have the Canton Fair. That's also, we'll talk more about that and what it means as far as trade goes. And towards the bottom, you have a story how U.S. tariffs could act as a catalyst for growth, according to officials. So this is really front and center for investors' consciousness right now as far as businesses go. Let's get more on this trip right now. We talked about how, the overall strategy from a U.S. perspective is to isolate China, get its military allies behind its economic umbrella. If you think about it effectively, that's also what we're looking at in terms of an exercise here from Chinese President Xi Jinping. He's gone from Vietnam to Malaysia and on to Cambodia. Let's get a sense right now of what's been done so far on the Malaysia front. And let's bring in David Huang with us, in fact, from Putrajaya to talk us through what's at stake here. David, let's start with that for both leaders. David.
Yeah, there is a lot at stake for both Malaysia and China. It's really difficult, again, to overstate the importance of these visits. I mean, after Vietnam, you say Malaysia, and then next to Cambodia. No, this is only the second time in more than a decade that the Chinese leader has visited Malaysia, which is, of course, ASEAN chair this year. And it's also worth noting that, yes, Malaysia, second leg of the Southeast Asian tour, which is, of course, Chinese president's first overseas trip this year, that when we first got wind of the Southeast Asian visits was in late March. And back then, it was really more meant as a way to tout the clout of China in the region. But then we saw April 2nd, Liberation Day, tariff announcements. And since then, it's been important for the Chinese leader, I think, to kind of pivot the purpose of the trip, to convince Southeast Asian leaders not to cut deals with Washington at Beijing's expense. So it's really that, along with the idea that China is trying to promote itself as a more stable partner than the U.S. For Malaysia, again, stakes very high. It's seeing China as its largest trading partner, as it has been for more than 15 years now. Total value of trade between Malaysia and China has exceeded $100 billion just last year. And amid all this, it is trying to negotiate with the U.S. So analysts have already pointed out it has to sort of maintain this fine balancing act being friendly towards Beijing but not antagonize Trump at the same time. Now, just behind me is the complex which also houses the official residence of Prime Minister Anwar Ibrahim, where the two leaders are going to be exchanging views later today. We're also expecting the exchanges of MOUs and remarks from the both sides. So a lot to keep watch on out of Malaysia today, specifically Putrajaya, the administrative capital.
And Avril, but there is a clear sector that is sort of caught in the crosshairs, and that's the amount of money that Malaysia's been putting into building out its data center infrastructure. Is that going to be one of the big talking points today, or what other sectors are going to be the focus?
Belle, I think you hit the nail on the head, because these Chinese tech giants have really been plowing billions over the past couple of years into investing in Malaysia's data centers. And by some estimates, we also hear how tens of thousands of Chinese firms are using Chinese data centers. So it's really going to be, are we seeing these leaders from two sides and talking about potentially how these investments will be intact or maybe even enhancing that? But don't forget, it's not just about data centers when it comes to tech for Malaysia. It is also a really big player when it comes to lower end semiconductors. So there's a lot that Malaysia can offer on the tech front. But today, the headlines about these critical minerals, a probe that the U.S. is announcing. China, at the same time, has been halting exports of rare earths. That is a mineral, an element that Malaysia has a lot of, but at the same time, it is still dependent on China to process these rare earths. So that's also another sector that could kind of come up in discussions potentially between the two leaders.
Avril Hong there in Putrajaya for us this morning. We'll be back with you, of course, for more updates as we await further details on President Xi's trip to Malaysia. But in the meantime, we've just had the Yuan reference rate coming out, so we're above 721 again for another session. Of course, a bit off the estimate, but still, it's certainly a story that we're tracking very closely, especially because today a lot of the front pages of media are saying or talking about how the PBOC has the capacity to try and ease policies as well.
We've really been waiting for any signs of that. We might get that window. I mean, and we've been seeing it almost on a daily basis. But maybe the data that comes through in about an hour or so might just give us a little bit more reason to expect more easing to come. A preview of the trading day ahead, plus of course the Boeing story and the China angle to that trade war iteration. Futures are pointing down as we approach the Wednesday open. This is Bloomberg.
China Southern Airlines has suspended the sale of 10 used Boeing jets. That's due to the escalating trade war between Beijing and Washington. That's after Bloomberg, was actually a scoop, revealed that China has ordered state-run airlines not to take further deliveries of Boeing aircraft. Let's bring in our Asia Transport reporter Danny Lee, who was one of the people on the scoop. So talk us through it. What is China doing here? And I mean, what are they trying to achieve?
Yeah, so China is trying to find some leverage to push back against the United States as we see this tit-for-tat between Beijing and Washington over these escalating tariffs here. So one of the key things that China can do is target one of the US's prestige companies here. And that's what they have done here, as we reported that China has asked the airlines to stop taking delivery of Boeing jets and to stop using or buying equipment and parts from US companies. So it is an escalation on some fronts, and we see the impact ripple through to how already China Southern, one of the world's biggest airline groups, it was already on the block to sell 10 Boeing 787 aircraft. They think they may need them now because of the potential delivery delays or for spare parts perhaps. We don't quite know exactly. But clearly there is an impact to all the decision-making that has come from up high.
I can imagine the reaction's been swift. What have we heard from the other side? And in the early goings, who looks to be the big winner here or the big loser?
Well, the reaction came from the top, from Donald Trump, President Donald Trump, who criticized China for reneging on an earlier deal of China to buy a whole load of Boeing jets during his first presidency. So he's not happy. Clearly, it's a sign that he is watching this closely by the fact that he has reacted to something like this amongst all the things he has to deal with on a day-to-day basis as president. But ultimately, for the winners and losers, you have everyone losing in the near term because China needs more aircraft. It has a whole load of Boeing aircraft. Ultimately, for the US, key exports and trying to muddle its way through this whole global tariff situation. It's gonna hurt in the near term. So, yeah, I don't see any winners out of this as the two countries face off.
Okay. Danny, thank you so much. On that bright note, thank you, Danny Lee, there on the latest on China, Southern, and Boeing. And we talked about, of course, the other side to that was the Nvidia story out of Minmin earlier on. Just 8 minutes to the opening bell. A weaker fix is causing a further leg lower in futures. And we're now looking at A50 futures down about 0.5%. Hang Seng poised to open lower between about 0.5% to about 1%. A preview of the open, including the data coming through today. This is the China Show. Good morning. Good morning. So we're looking at pressure across risk assets. As you can see, NASDAQ futures are off by about 1.3, 1.4%. That's the Nvidia story pulling down the contract itself. Within the chip space, within the Asia Pacific, we're underperforming the benchmark, which is down about 0.5% by about a factor of 3. So the Asia Semiconductor Index that we track here at Bloomberg is off by about 1.5%. A lot of that is TSMC. And of course, a lot of money is coming in, again, out of the dollar into havens, used to be the dollar, like gold, going into today. Right, now on that very note, so the dollar is weaker, but also the Chinese currency. The weakest fix, again, a 721 handle out of the PBOC, and that's, as you can see, leading to a further leg down in A50 futures going into the open today. So it's looking like most things will be on offer as we approach the open here today, Belle.
Yeah, and it's not just... this that we're watching, of course. Beyond that, we've got the GDP figures coming out. We've got the monthly activity numbers as well. Backward looking, I guess, but it's kind of like the final pulse check before we head into the trade war. How was the Chinese economy going just before President Trump unleashed all of these tariffs? And actually, I forgot to mention as well the property figures that are coming out. So we've got new used home prices as well. And we've actually just had Premier Li Qiang vowing further efforts or further measures to try and stabilize the property market.
Yeah, in fact, in a couple of minutes here, as we look at the open and as we look at the property price data, which comes out at about the open here, Kinjer Lau will be joining us out of Goldman Sachs. And they actually have a proprietary U.S.-China relations market pricing barometer. It tries to, it attempts to measure how much risk is priced into the current markets right now. That's at 2-year highs. We'll ask him what that means. 20 straight months, 21 straight months of declines. We'll see what this looks like at the open. So the opening bell, just over 3 minutes away, pointing lower here in Hong Kong and up in mainland China. You're watching the China Show. Good morning.
Welcome back. You're watching the China Show. We're counting down to the open of markets this morning. We've seen futures pointing to some weakness here, particularly in the Hang Seng. It is another day of tariff tensions. The big headline this morning, of course, is President Trump restricting Nvidia's exports of the H20 chip to China. So that's a chip that they specifically designed for the Chinese market. But now, essentially, the concern from officials is that even that sort of chip is too advanced for China. Yeah, and Nvidia put out a number of what the effect is going to be on them. I think it's about $5.5 billion is the write-down. That's an inventory play. So we're looking at semiconductors and chips. That's one sector. We're looking at gold producers on the back of a record high there for gold. Property, consumption, and everything in between with the data coming out today. And, of course, airlines on the back of the China Southern story and the Boeing story there. So, yeah, lots to unpack here, all related somewhat to the trade war to varying degrees here. We're looking at a flat open on CSI 300s. We should be getting the property price numbers out. We will mention that once we do have a better indication of those numbers. Flip the page, please, and have a look at Hong Kong, where the Hang Seng Tech Index actually closed lower yesterday. Hang Seng China was still up
into the close. We're looking at declines there of about 1.2% on the Hang Seng China Index, which, by the way, is on a 6-day win streak. So that's the longest since the DeepSeek moment, actually, back in late January. Further downside on the Hang Seng Tech, we're looking at about a 2% there, HSBC. But as you can see, wow, okay, that's quite a substantial drop across some of your big tech plays. Baba's down about 3.5%, Meituan 3.5%, Baidu is off by 2.5%, and Xiaomi 1.4% to the downside. Have a look at chips, please, if we can, very quickly. So we have Huahong and SMIC, and of course you have some of your AI plays that perhaps that might get affected because of access to some of the chips there, or, that's a narrative, certainly. Now, in terms of tangible effect, we've yet to actually do the math on that. Upside across your chips, self-sufficiency, if you could call it that sort of theme here, and SenseTime is down 1.4%. That's an AI play. Gold and airlines all seeing some upside today, so rather expected if you look at this, Bill.
Well, we just had the property prices coming out. Okay. So just to go through these, so the new home prices still in negative territory, down 0.08. That's actually better than the month we had prior, because it was 0.014 in the month prior to that, so in February. But March, still decelerating, but not as much as before. Used home prices as well in negative territory, down 0.023 or 0.023, but anyway, point is it's done better than the month prior as well. So again, you're still seeing weakness, but better, a bit better.
Yeah, so I'm looking at, I'm just going to update my chart here. This is almost a cue to my producers to get this ready in about 5 seconds or so. So, yeah, we put the data now on the chart for you guys. 22 straight months. If we could load again, 2402, guys, if we can here. Big picture view that Bell was pointing out. So things are certainly, it's a more subdued slump. The decline in home prices and new home prices that we got for the month of March, okay, that's a look actually at our chart library. So that's a look underneath the hood. 2402, if we can bring that up, please, if we can. So a decline in March was actually slower than the one that we had back in February. All right, that's a look at how the sausage is made. Okay, let's pivot now, and why don't we talk about markets? Why not? And geopolitics, right? So Goldman Sachs actually came out with revised targets on their benchmarks because of what's taking place. The other thing what's interesting about the latest Goldman report is they have actually this barometer of U.S.-China relations. It's at about 2-year highs. There's a number there. We'll ask Kinjer Lau, of course, who oversees their China equities coverage for Goldman Sachs, what that number means, plus, of course, their new strategy, given the reality we're in. That's the graphic on the screens. Kinjer, thank you so much for joining us. Good morning.
Good morning.
What does this graphic mean in simple English? What does this mean?
Well, in essence, this is a proprietary indicator that we created, a measure to help quantify to what extent the bilateral tensions between U.S. and China are embedded in equity valuations. So in simple words, when we look at a chart, when the line goes up, it means higher market-implied tensions between the two nations across 4 strategic cohorts: trade, technology that Annabelle just talked about, geopolitics, and financial markets.
So I'm just looking at it now. The current reading, it's still not back to levels that we had a couple of years ago. Does that tell you that things can get a lot worse from where they are today?
Well, I think you can also put it another way, saying that the market concerns about U.S.-China relations are better anticipated or expected now than 2-3 years ago. Especially over the weekend, we received a lot of questions about ADR delisting. Right, this is a hot topic right now in the markets. And I would say, if you look at what has happened over the past 2 or 3 years, many pure ADRs have come back to Hong Kong for dual listing or secondary listings. So they're better prepared for some further decoupling risks between the two nations.
Well, I guess, should we expect more homecomings then? Because I think the observation that you guys have put out is, if for those Chinese companies that do not have a listing here, you've really seen a massive underperformance in that specific cohort. Should we expect them to list here? Like, how is it actionable for investors?
I think conceptually it makes sense for the pure ADRs to actually consider the options of having the listing in Hong Kong because of the ADR delisting risk. On top of that, if you come back to Hong Kong and subject to certain requirements, you'll be able to access mainland liquidity through the southbound channels, which obviously is a big boost in terms of your liquidity profile as well as valuations. So based on our latest estimate, about 27 ADRs are eligible for Hong Kong listing via the secondary channel or the dual primary channel.
Okay.
Yeah, this really stood out to me in your reports. So it sounds like this is actually one of the key concerns, this delisting risk that you're hearing from investors.
I think delisting risk is one of the topical questions, but on top of that, obviously, is the trade war. So we talk about 100% or higher than 100% tariffs that U.S. is applying to China, and China is also charging the U.S. So against that backdrop, I think our view, hopefully, is clear that we need to look inward, right? Look for support domestically, whether it's policy or liquidity. So the orientation of our strategy is very, very, very straightforward. There are really two keywords that really cut across all the strategies that we have in the equity market universe, which are domestic and policy. And that's the reason why we, despite revising down the index target, we upgraded banks to overweight. And we believe that banks, purely domestic, right? And from a liquidity perspective, I think our national team will continue to provide some accommodation to banks from a liquidity standpoint.
Including property. You've also upgraded property. Are those along the same... Is that along the same logic there?
Yes, I think we are seeing some green shoots in the property market, particularly in higher tier cities, in terms of transaction volumes as well as pricing. And the land auction activity has been pretty robust too recently. So given where we are on valuations and many investors are underweight the property market, the property sector, and we do believe that it's our economists' view that in the next few months, we'll likely get more policy support, specifically in the property market. So I think it checks all the boxes.
I know the news is rather fresh on Nvidia and the restrictions that they can sell to, say, the Chinese market. How do you suspect that affects sentiment around some of the AI plays in China that perhaps already have access, already have enough supply of that, but does that affect in any way sentiment across some of the AI darlings in China?
Yeah, it goes back to the barometer. So technology is one of the components in the barometer. So clearly that will likely put more upward pressure on the barometer. But when it comes to fundamentals, we still believe that if you look at the DeepSeek development in China, the so-called sort of localization theme is going to extend in the near future. So I think clearly this is a near-term supply disruption, but over time we believe that China is able to rely on domestic technologies to further grow the economy.
So then breaking down into tech in particular, which parts of tech are you looking at? Are you looking more at the hardware play, software? Which names are standing out to you, which areas? Yeah,
broadly speaking, if you just divide the tech universe into hardware and software, we prefer software. I think hardware is a little bit challenging, particularly given the tariff uncertainty that we are talking about here. So within the AI ecosystem, we've been very vocal about, okay, if you want to invest, the software companies, cloud operators, or the platform operators will be in a better position to monetize the AI upside. Because I think that right now we're in a phase of the AI development cycle, which is really focusing on development of use cases and how to monetize AI technology.
The new index target, let's just use MSCI China here, 75. The assumption you're making here on the tariffs is quite extreme, 125% effective tariff. What is the assumption on earnings growth? How does the earnings growth change with a tariff of this nature?
So before the so-called Liberation Day, April 2nd, our earnings forecast was 9% earnings growth for MSCI China year on year. Now, our current number is 4%. Okay. So basically reflects what you said, the escalating trade tariffs, and also quite importantly, the ripple effect to the economy. So our economists just very recently revised down our growth number for this year from 4.5 to 4%. Yeah. So if you account for these two impacts or channels of impacts, then they're where we are.
How are you thinking about the Chinese consumer then, and different consumer plays?
So right now, if you look at the hard numbers, I would say it's still quite lukewarm, or particularly on the pricing side of things. CPI has been pretty soft over the past couple of months. But again, I think on a look-forward basis, we believe that policymakers will come up with some meaningful stimulus to help consumer appetite and ability to consume. So I think the upcoming April Pro-Bill meeting will be the key event, and because we think this is the window for policymakers to come up with something more meaningful to stimulate the consumer economy.
We just spoke with your colleague David Huang in the U.S., and I'm wondering, people are trying to figure out, is U.S. exceptionalism over from an equity basket? Is it an EM leaning? Is it a U.S. leaning? Just give us a sense of what that internal discussion is between you and your U.S. colleagues here in terms of equity strategy.
I think David Huang and also Peter Oppenheimer, who is our chief strategist for the global equity markets, they've been very vocal about the need for investors to diversify. Right, diversification has been the key across all the Goldman strategy research in the past 1 to 2 months. So I think this is very much consistent with the feedback I got when I was in the U.S. a month ago. I had a lot of meetings in the U.S. and talked to U.S.-based investors. At that time, tariff wasn't the big concern, but still people they were looking for diversification opportunities outside of the U.S. market, whether it's EM or other DMs.
There we go. Kindra, fantastic. Thank you so much for coming in to give us your latest report here. Kindra Lau there, Chief China Equity Strategist at Goldman Sachs. We're looking at markets, 1.4% to the downside on Hang Seng China. Hang Seng Tech is off 2.5% in the first 12 minutes of trade. This is the China Show.
Well, President Trump says the ball is in China's court to reach out and try and resolve their trade fight. But a former top Chinese official says Beijing will only engage in talks if U.S. leaders show respect. Former Deputy Finance Minister Guangyao spoke exclusively to Bloomberg about China's negotiating principles.
I think for this specific negotiation should be based on real instruction by two presidents. President Xi highly emphasized the relation with the United States. President Xi always emphasized based on three principles: mutual respect, coexist, and win-win situation to develop a healthy, stable, and sustainable relationship with the United States. That's China's policy. That's President Xi gave clear instruction to all level of Chinese staffs. That's based on that. I was before to deal with U.S. in economic. We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything, maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because that's, we don't want the whole world return to the jungle of jungle law.
So just to be clear, right now the two sides are not on speaking terms. Officials on two sides are not discussing possible solutions to the trade war. Is that correct?
That's subject to how do you define that. If that's U.S. want China totally accept the U.S. proposal, to accept U.S. conditionality, I think that's no negotiation. And must be under the mutual respect and with this joint win-win situation.
What does mutual respect look like? Would the U.S. have to reduce the tariffs to 85%, 60% to bring President Xi Jinping to negotiations?
I know in U.S. team always think the President Trump is the top negotiators. Art of Deal, the book written by President Trump, and let's do business. Now it's country-to-country relations. We should exactly follow the rule of WTO to deal with bilateral trade dispute rather than to use just pressure. Since People's Republic of China founded, China never yield to outside pressure. So that's why I hope real negotiation for trade imbalance issue should be based on mutual respect, not just used as pressure and let the other side accept all conditionality raised by U.S. That's impossible.
Mr. Chu, when you take a look at the markets, there's a lot of concern about China possibly selling off its holdings in treasuries. Has China done that? Would China do that? Has it ever considered dumping U.S. treasuries?
In my working experience, we have very close communication with staff of U.S. Treasury. I understand very well the U.S. Treasury careful very much about the yield and about price of U.S. government bond. And now, if that's 10 years, U.S. government bond is more than 4.5%. I think, frankly, that's big pressure for U.S. government spending. Because last year, 2024, U.S. government bond interest payment is 1.12 trillion U.S. dollar. And U.S. trade deficit is 1.2 trillion dollar. That's 2 more trillions. I understand that should take action to correct, but correct action, not use the way of reciprocal tariff.
Would China consider dumping and selling U.S. treasuries to counter the trade war?
I can tell you, I used to be in the press conference said very clear that the Chinese investor, Chinese government as very responsible investors, we understand how important of global market stability. However, this is based on mutual understanding, mutual respect, and mutual cooperation. I really hope U.S. and China can, based on mutual respect, return to negotiation to solve the problem each side concerned.
I want to touch on the Chinese yuan. We've seen the daily fixes being weaker than anticipated by the market. Are we seeing the signs, the beginning of the signs, of a devaluation of the currency?
And Chinese yuan and our renminbi policy is very clear. It's relatively stable. It's our real driven policy. And you can see recent weeks, even this big market turbulence, but renminbi yuan keep this relative stable. Even that's 7.3 up and down, and that's market fluctuation. But in general, we see the relative stable policy is our policy.
Some say 7.5.
7.5, 7.3, and that's a small fluctuation because we have the central level
band
price, and People's Bank keeps us very careful to manage this band, and that's why we have full confidence. Even this big turbulence of international market, renminbi will keep relative stability, and China will contribute to the global market stability.
That was the former Chinese Deputy Finance Minister Zhu Guangyao speaking exclusively to Inside anchor Haslinda Amin. Right, just ahead, so in about 10 minutes or so, we get the data dump, everything from GDP, first quarter GDP, to your monthly activity indicators. And we'll be joined by JD.com's chief economist to talk us through where he thinks the economy is, certain highlights, of course, that he wants to bring up as well, including, by the way, he's one of the people that met with Premier Li Qiang. So we'll see how that conversation went. Catch that conversation just ahead. At those times, this is The China Show.
You're watching The China Show, and some of the big stories that we're following this morning. Well, the Airport Authority Hong Kong is said to be seeking a syndicated loan of some $2.6 billion US. Sources say the proceeds will be used to refinance a $4.5 billion loan that's due in June and for working capital as a major expansion continues. In January, the airport completed one of the largest bond offerings by a Hong Kong issuer, worth around $7 billion. Hong Kong Post is suspending service for items to the US. That follows Washington's decision to eliminate the duty-free status of small postal items sent from the city. Washington is also increasing duties next month for postal items containing goods to the US. In a notice, Hong Kong Post warns residents might have to pay exorbitant fees due to what it calls unreasonable and bullying acts.
Right, just looking at some live pictures out of Beijing as we look at these cash markets right now, everything from big tech, and we'll get to consumer and property in a moment following the numbers coming through. The reason we're looking at that is in a couple of minutes, in case you missed that, we are going to get the release of first quarter GDP numbers. We get separately March activity numbers, so that's everything from retail sales, a breakdown of retail sales, the change in retail sales, the value of retail sales, and the various categories that make that up. We're also getting industrial output numbers coming through for the month of March, and effectively we're looking at, just to give you a sense of the median forecast for industrial output, 5.9%. The high end of that is towards a 6.4%. The low end is for 4.8%. That's the range. And a look at some of the property names on your screens. In case you missed our conversation earlier on with Kinjer Lau out of Goldman Sachs, they've gone overweight on banks and also on property. A look at the benchmarks going into the data release in a couple of minutes. The second hour of the China show is just ahead. Welcome back. You're watching the China show. A look at the Hang Seng Index half an hour into the session. We're counting down as well to the data release. Ahead of that, though, President Xi Jinping is in Malaysia, and Avril Hong is there on the ground to just get us up to speed on what's happening. Avril, very quickly.
Absolutely, and he's set to meet with the Malaysian Prime Minister Anwar Ibrahim in the administrative capital Putrajaya, where I am now. For Chinese President Xi Jinping is really about securing supply chains as well as reiterating the potential for bilateral cooperation with Southeast Asian countries. Hopefully as well convince leaders of these nations not to cut tariff deals with Washington that will come at the expense of Beijing. Now, Malaysia in this regard has a lot to offer, of course, because of what it's seen in the tech space, potentially with the data centers. Maybe we see some deals there. Also, remember, it's a big player when it comes to lower-end semiconductors. So all this are really going to be top of mind when it comes to the meeting.
All right, Avril Hong there in Putrajaya, and just we've got the breaking news coming out now. So we'll start off with what we've seen in the GDP, because actually it's come in matching the highest estimate here.
Wow.
So expansion of 5.4%. The estimate had been for a reading of 5.2%. But actually, when you take a look at the monthly activity data as well, David, it's looking pretty robust.
This, at first glance, looked to be a beat, if not across the board, almost across the board. In fact, to the point Bell was making, at 5.4% on first quarter GDP. And yes, I know it's backward looking, and yes, I know it's before the tariffs took place, but it gives you a sense of momentum here. That came in matching the highest estimate. Retail sales for March, 5.9%. Median was for 4.3%. The high end of that range of forecast, I'm just looking at my data right now, coming in at 5%. So also retail sales beating the highest estimate. On industrial production, just give me a sec. I'm having to do some basic math. Sorry, I'm not that good. 7.7% year on year. The estimate was for 5.9%. That one also coming in above the highest estimate. So it looks to be, Bell, this looks to be a beat across the board. We're coming across the Chinese currency right now, some strength coming through there. So some decently positive reaction in the markets. More context, of course, is coming through as well when we get the press briefing underway. We'll get those lines in a moment there. But on that very note, let's bring in Shen Jianguang, Vice President and Chief Economist at JD.com, for his initial take and really where we go with this economy here. What's your sense of the numbers so far, from based on what we've heard, what you've heard from us?
Yeah, the number is good, but it's to me it's within expectation.
Okay.
Because the consumption has been very strong due to the government trading policy. Last year, the second half it's 150 billion, but this year, the beginning of this year, government announced 300 billion more than double. And also the products that can enjoy this subsidy from government has widened substantially. So from our big data, daily data, I can see the sales, retail sales are really good. So I think that's probably the main reason why the retail sales has been much higher than the average of last year of 3.5%. But of course, we also know because of this the trade war threat, so the exporters and the producers are producing a lot and ship the goods a lot. So I think so the first quarter will be a very good quarter. That's I expected. But so 5.4%, that's perfectly, to me, it's quite normal, understandable. Yeah.
And we've got this National Bureau of Statistics briefing that's just kicked off this morning in Beijing, going over these numbers as well. And we're getting some more lines from this as well. They're looking at an action plan essentially to try and improve consumption. They're looking at service consumption in particular, but also looking at other areas like catering, tourism, leisure. It's clearly a big focus of of officials rather to try and lift. But I'm curious. From your perspective, we've seen the trade-in policies. Yes, they've worked, but does that actually work to really stimulate organic consumption as well?
Of course. If you think about this medium longer term, it's about income. It's about wealth effect, right? It's about consumer confidence. That certainly is a long-term issue. But just the problem is without this trading policy, I can see that the first half of last year, most categories like home appliance have a negative growth, in retail sales. So, but after the trade-in, it's become positive, and now it's really taking off. So it's a short-term policy stimulus that can lift the consumption and to regain the consumer confidence. I think to this regard, it's very, very successful.
Right, and you have a very unique perspective on this as an economist working within the tech, and not just the tech sector, you're working within actually a company that has a lot of data on what people buy, where they're buying from, their purchase patterns. Could you give us a sense of how that informs you about consumption patterns moving forward? And does the government need to remain in the market with these trade-in policies to keep purchasing activity supported?
Yeah. Of course, for example, last year we can see, the consumer markets has been, affected very negatively, without the stimulus policy. And for example, the necessity goods are still doing okay, but this kind of luxury goods and this durable goods are not doing very well. Was not doing very well. We can see the home appliance all, declined. It's not positive growth last year. So that's why, also we propose also it's time to have this like a consumption voucher or this trading policy. But the government actually, adopted policy, announced 150 billion subsidy. So that's very, very strong stimulus. And this year will be double, so that's why it has been very positive.
The other question I had was, I think maybe for the first time in let's call it 2 decades since China entered the WTO, where the maybe purchasing activity and retail sales is holding up, but it's not as straightforward an indicator of earnings because of the price pressures we're seeing, margin pressure, price competition for many goods. I mean, to the point you're making, right? Basic goods are doing better than luxury, for example. What signals are you seeing as far as future inflation is concerned based on the pricing you're seeing in your data?
Yeah, I think from the consumption pattern, actually you can derive the income pattern as well, right? So that's the issue. I think the income growth still from the Statistical Bureau is still positive, but the level has been much lower than in the pre-COVID period. That time it's probably growing 7-8%. Now we are seeing like 4-5%, right? So we can see a deceleration in income growth. So that's a concern. And another issue is about the wealth effect. You can see the stock market and you can housing price. So I think that's probably the focal area that government will need to tackle, and probably they will adopt policies to boost the housing market and to boost the stock market. That's, I think, will be very important.
Because you have met with the Premier, Li Chang, as well, to go over some proposals and to share your views on the economy. You mentioned the subsidy program. Was that something that you put forward recommendations on that as well?
No, I think it's not, because this policy has been adopted already by the government in the last year. So that's been under intense discussion. In the first half, there's almost only 10 billion subsidy, but second half become 150 billion. This year becomes 300 billion. So I think the size is already sizable. But I believe probably they will widen it further, right, to maybe to 500 billion. It's not only just to home appliance, to electronic products, maybe go to service sector as well. Service sector, I think it's not using trading policy. It probably will be the consumption voucher, pattern type. It's maybe more suitable for consumption. Another thing I think is very important is for this newborn baby, right? So this this subsidy by the government, for example, just for example, 10,000 renminbi per newborn baby. That's the policy I think will make a lot of sense in Chinese current circumstances, because they want to stimulate this population, right? The younger population has been, the proportion is declining. So, and that's the money size is not big. It's 100 billion renminbi a year. You can cover every newborn baby in China.
Yeah, and I think the issue markets are trying to understand, and increasingly they're understanding it better. But there seems to be an information gap. In what form will fiscal stimulus show up? And I think to the point you're making, subsidies is actually one part that we're getting a lot of support, right? It's not a big bang stimulus, but it is money in the system to help people purchase. We actually spoke, and I want to get your thoughts on this. We actually spoke with the former Deputy Finance Minister, Guangyao. Can we play it out, guys, and we'll get a reaction here from our guest?
For central physical capacity, we have a large room, but we also, to be honest, we also should deal some challenge, local government debt issue. So that's why several months ago we took action, increase 14.3 trillion renminbi to deal with the local government debt issue.
So I guess my question there is, in what further form and magnitude should markets expect fiscal stimulus to appear?
Yeah, I think there was two fundamental shifts in Chinese macro policy. One is to really break all the red lines about like 3% fiscal deficit, to increase the government debt to boost the economy. I think this is one thing. So that's why as the Minister Zhu said, right, it's 14 trillion. I think the more to come. It's just for example, I believe there will be more fiscal policy to stimulate the housing market, right? To buy this kind of unsold apartments or even the land. So that can boost the property markets, and so that is, I think, once you have you have broken the red line, and you can do more fiscal stimulus. I think that's a very good development in Chinese macro policy. The second one is to shift the policy focal point from investment to consumption. That's why most of the stimulus will be focused on the consumption instead of investment. Yeah, that I think is two fundamental shifts in Chinese macro policy. That I believe will be quite important. Especially the first quarter GDP growth, you can see is mainly the result of stimulus in the consumption side, as well as the enlarged fiscal stimulus. I think we see the figure, right? So without this trade war, I believe this momentum will be good. But because of the trade war and the second quarter will be very challenging. That's why the government is probably very angry with the trade war. Otherwise, this momentum will continue.
Yeah, difficult to discount the trade war, though, right? Shen, you're sticking with us. That's Shen Jianguang there, Vice President and Chief Economist at JD.com. And a reminder, of course, we're going to be talking about consumer trends in China with the CEO of e-commerce company Yatsen. We'll have that and their views on the tariff impact in just a few minutes. And, of course, the T-Life blog, that's still underway as well. So you can get more details on the monthly activity figures that just dropped strong across the board. But you're watching Bloomberg. We have more ahead.
Welcome back. You're watching The China Show. We just had some numbers coming through out of China, a beat just about across the board, and not just a beat. A lot of these numbers coming in well above the highest estimate, but the caveat there is, of course, backward-looking. We're in a different world right now with tariffs. To help us understand how we need to be thinking about that forward-looking here as far as markets go, Mark Cranfield is with us out of our MLive team. Mark, we're seeing, to some extent, the yuan coming off lows of the day. Is that a good indication of how markets are reacting positively to the numbers? Where is your head at the moment?
I don't think it's got much to do with the numbers you've just seen at all, really. Obviously, people expect there to be an awful lot of front-loading in those numbers, and China will have to be seen to be keeping up the stimulus for quite a long time. That's what investors will be looking for. They'll be looking for soothing words on that front. I mean, as you heard from David Huang earlier, you got President Xi Jinping is in Malaysia now. He's completing an Asian tour. He's trying to encourage a lot of support for China on a trade basis. That is something that investors will certainly respond to if he can be seen to be getting some support in that area. That would clearly be good for Chinese markets. So those early stages from that point of view. In terms of the currency, it's pretty clear. We had the way the fixing went again today. We set a new high for this cycle. The PBOC is clearly on the same mandate that it's had for some time. They're gradually weakening the yen in relation to the US dollar. And in fact, they're also keeping the yuan relatively weak within the basket as well, because you can see it's also at very weak levels against the euro especially. So nothing really has changed from that point of view. And as you were discussing earlier, there doesn't appear to be an immediate timetable for Presidents Trump and Xi to speak together, which clearly, from a global markets point of view, that's the most important thing. People want to know when is one or other going to step back and going to find some common ground where they can actually reduce some of these tariffs which are currently on the table. So in that respect, that's the big picture. Nothing too much has changed. And we're coming into a very long weekend. US markets are closed on Friday. Hong Kong markets are closed on Friday and Monday as well. So from a risk-taking point of view, the news from Nvidia that they could have to write down more than $5 billion couldn't have come at a worse possible time. It will be very hard to get a bullish attitude towards markets between now and the weekend.
Yeah, certainly, and actually just taking a look at trading volumes as well. I mean, they're pretty thin this morning. So that was our MLive strategist, Mark Cranfield there. Let's bring back in Shen Jianguang, Vice President and Chief Economist at JD.com. So we were just hearing there from Mark talking about, this expectation that, well, obviously traders would like to see, a lot of people would like to see President Xi and Trump come to the negotiating table together. But it seems like, even with the Nvidia news, they're even further apart. So you've spoken about that meeting with the Premier Li Qiang. What's your sense of the preparedness of China for a protracted tariff war now?
Yeah, I think the trade war is very unfortunate, right? China and the U.S. are the two countries I think benefit the most from the globalization, benefit from the trade. The U.S. GDP per capita has reached $85,000, and China became the largest producer, of the world. And the two countries are also leading in this AI world. So a lot of things are good about this, trade previously. But the trade war will destroy everything, right? So we see all the disruptions, but we see the first casualty is the stock market, not only in China but also in the USA as well. You can see the adjustment. The dollar weakened, right, and the bond yield has surged. And because people are afraid of inflation in the U.S. So a lot of things, a lot of damage already done to the global trade and the market as well. So certainly everyone hope that a trade deal can be done finally. But I believe because now we need to see it's not that the one country can dominate everything. Whatever I do, everyone have to yield. I think that the age of that has gone. So everyone have to, come to the negotiating table with some respect for, attitude. So, equal footing. That's probably the precondition for negotiation, I think.
Right. Do you get a sense right now that China feels they're being disrespected by just the tone and rhetoric coming out of the White House? In other words, how soon could we expect both sides at the highest levels, at the levels they matter, to strike a deal? How soon could that happen? And what do you think? What's your sense of what kind of deal China is ready to offer here?
I think, from, Premier, the Minister Zhu, as said already in your program, right? All the message from Chinese Minister of Commerce said very clearly, Chinese door for negotiation is always open. So, if you want to have a trade war, we will, we will fight. If you want to negotiate, we will. But it's not that we are begging for negotiation. So, right, it's like everyone can, maybe China is waiting for the U.S. side to realize, the trade war is ultimately also very bad for the American economy. And then probably, both sides can agree, we need to negotiate on equal footing.
We're just, again, getting some more headlines dropping from the MBS here saying that, a lot of enterprises are still in difficulties. Domestic demand is insufficient. Given how protracted this is and how many areas are being discussed and how many investigations are underway, semiconductors, pharmaceuticals, how long or what does it look like, I guess, over the next few months? What are the activity numbers going to look like, for instance?
Given all the past few days or a couple of weeks, you can see it's so uncertain regarding the White House decision-making process, right? First, they no negotiation. Every country have to, get this all the tariff. Now they have 90 days pause for all these countries except China. So a lot of uncertainties. I don't think everyone can really confidently say, what will be the, process and the outcome. But to me, as an economist, I can see, it's so bad. It's a hurt, both China and the USA. It's so badly, Definitely, there's room for negotiation. So that it's a win-win process if both can negotiate, right? Then otherwise it will be lose-lose. So that's why, from an economist point of view, it's from a rational point of view, they will come to maybe a negotiation table, find a mutually beneficial.
You make a very good point there because arguably the Fed is in a much more difficult situation right now than the PBOC, right? The Fed has to deal with slowing growth and high inflation, and their hands are tied as far as monetary policy is concerned. We're showing a chart right now. Money supply in China, growth is near historical lows. The credit impulse is also quite subdued. What tools do you think, what further tools do policymakers have in case they need to level up on supporting this economy?
For example, for China and the U.S., the business cycle is very different. It's the opposite. China is facing, this the bottom side of the business cycle. The slowdown in the economy for the last 3 years, the housing, the bubble has been burst already. So the interest rate has been very low. So I think they are the opposite of the. So that's actually, as you said, the challenge for Fed is even more daunting because they are facing the bottom, the top of the cycle. The U.S. dollar has been strong. The market has been the valuation very high. So and the inflation has been declining, but now it's probably facing resurge again. So for them, it's to me it's a more difficult challenge. But for China, I believe they will keep the renminbi stable. I don't think China will depreciate the currency as a weapon to counter. So I think for the Chinese policymakers, it's very clear they have further room to cut. And to boost the economy, the housing market. But for the U.S. side, as you say, are facing, Fed is facing a dilemma. Yeah.
So they won't use the currency. In 10 seconds or so, do you think they'll use the Treasury card? Do you think they might end up selling Treasuries?
I don't think so. I don't think so. I think, trade war, it's trade war. Don't spread to the financial war, right? So that's the best for both interests.
Fantastic.
Containment. Yeah, okay, that's interesting.
Yeah.
Thank you.
Yeah.
Shen Jianguang, thank you so much for the time. Vice President there and Chief Economist at JD.com. Right, you can turn to your Bloomberg for more on this. Tia Live we go, more commentary, analysis on everything that's going on. There's a live briefing taking place, live data coming through as well, coming out of the Chinese mainland. A sell-up that is taking place across the tech space here. Hang Seng Tech off by about 3%. This is The China Show.
This is a story I'm actually watching this morning. This is e-commerce stocks, and I'm kind of excited about this one because we were talking about it yesterday about this phenomenon that we've seen on TikTok. It's spilling across to Instagram, but it's essentially all of these suppliers or people that are purporting to be suppliers or manufacturers of major Western brands like Lululemon, for instance, going online and talking about the real cost of production and then also making that inference that Western brands have a big markup. Off the back of that, there's actually been a surge in downloads of this app called DHgate. It's also known as the Yellow app.
What does it do?
Well, it connects wholesale sellers directly to customers, and it's now become the #2 downloaded Apple iPhone app in the US. So it's really that whole interplay. You see Trump tariffs. People just really want the best price sometimes.
The question there I have is then, if you're able to find the maker, how do you get that shipped in with that sort of loophole closing?
It doesn't necessarily close the loophole, but I think the point is that you're getting a better price because you're getting connected directly to the wholesale seller. What I do want to say, though, is caveat emptor, of course, it's buyer beware. Maybe they're not the real thing, but it's still connecting you to new factories. So, you again, seeing those stocks jumping in the session so far this morning. So, listing plans.
Okay. Welcome back. You're watching the China Show. Right, more breaking news coming through out of the National Bureau of Statistics taking place. And interesting, following the release of economic data, commentary, context around the trade war taking place. Point number one is that the tariffs will add some pressure on growth. Despite that, though, China is confident in meeting its economic growth targets. It's now less dependent on a single market, and China is looking to foster new growth patterns ahead. This is an ongoing briefing taking place in Beijing on the back of the release of just an across-the-board beat on economic numbers, everything from first quarter GDP to monthly activity numbers, more coming through. Domestic demand is contributing to Chinese economy, more on the notion that they are looking to insulate output by looking inward and strengthening what they can and pulling the levers over parts of the economy that they have more control of. Numbers on your screens relative to estimates. As you can see, it's a beat just about across the board. We'll get to you more details on this in a moment, but in the meantime, let's have a different conversation, related one, of course, in terms of retail, e-commerce, and consumption. Bill.
Yeah, well, Dave, actually, I think it's really related to that retail story, the consumer story as well. Joining us now is David Huang. He's CEO of Yatsen. That's a Guangzhou-based e-commerce company. So you do have a very ambitious turnaround strategy, David, and thanks so much for joining us in studio this morning. But for viewers that aren't familiar, Yatsen, talk us through the brands, the portfolio of brands, the kind of companies that you're looking at as well.
Sure. Well, thank you for having me today. So I founded Yatsen in 2016 with a vision to create a world-class tech beauty pioneer. So we have, starting from our first brand, Perfect Diary, which is now a mainstream beauty brand in China. And we expand our brand portfolio to covering the premium, masstige, and the mass price tier. Now we have a brand portfolio about 11 brands, including Galanic. It's a science brand coming from France, and then very focused on the cellular anti-aging benefit. We have Eve Lom, it's a British skincare brand, spa, feeling, sensorial. And then Dr. Wu is a dermatologist brand, and we have covering makeup and skincare right now.
Mm-hmm. Yeah, so that sort of focus on different tiers and makeup, general skincare as well. I want to talk about the retail sales that we just had as well, because they were very strong, the figures at the top of the hour. As a business, what kind of consumer appetite are you seeing for your products, and how is that changing, maybe off the back of subsidies, for instance?
China beauty market is a very dynamic market. It's 400 billion RMB bigger. And it's also a very fragmented market right now. So even the top players are taking single digit of the value share. We are around 1% of value share. So the Chinese consumers, they still have a very high appetite for the next generation of the beauty products. They're looking for products with more science-proof technology supporting benefits. So I can give you one example is, so we launched Perfect Diary by Lip Essence lipstick. The price point is very similar to the international players. That was in 2023. But it's not only a lipstick, it's also a hybrid product. So it combines color and skincare. So with our patent ingredients, the lipstick can help your lip skin to regenerate collagen, so that to help you remove your wrinkles. So the products become very top selling in China. So going back to your question about the Chinese consumers about beauty products, they still have a very high willingness to pay as long as the products can deliver true benefit.
Okay, so it's sort of a science-backed approach. That's more of a premiumization strategy. Is that the model that you're following?
The China beauty market is big, and then there are always segments. There are some consumers, they favor value for money products, or they favor the trendy and then fashionable design products, or they prefer the legacy brands. We observe a major shift of the consumer preference to more science background and also technology supported products and brands. So that's why we ride on the trend to place our strategy on the really heavily bet on the R&D. So we invested over $80 million in the past few years, 3% of our revenue, which is top tier globally, and we filed over 240 patents. So that's why we can come up with products that the consumers are repaying us with the loyalty.
How has that been received by creditors? Because, of course, if you were to look at Yatsen's peak of stock price, you're well off that today. How is it being evaluated?
After IPO, we went through a turnaround stage. So in 2021, we announced that we need to heavily invest in R&D, expand our skincare revenue of the total revenue split, and also resume to a profitable growth stage. It took us 3 years. It was not an easy journey. And then we finally turned around the business. As a public company, we do care about the returns of the investors. One of our beliefs is that long-term wise, the equity market is a weighing machine. So that as a team, we really focus on growing the equity enterprise value. So we focus on doing the right thing, R&D, building brand, launching nice products that consumers are loyally repurchasing, and then resume to a profitable growth stage. So that's the way we can commit and also have the long-term growth.
But how is it being received by investors then?
Since the issue of our quarterly report last Q4, we are getting more and more positive feedbacks. However, there is some market turbulence happening right now. So we still very focused on the long-term growth strategy because it's proven right, and then we need to execute it continuously.
When you say so it sounds like creditors or stakeholders are maybe a little bit concerned around perhaps trade-related issues or what that means for the Chinese consumer. Are they some of the concerns that you're hearing?
Tariffs has great impacts on every industry and every company. Beauty industry is a highly globalized industry. So we are now closely monitoring the potential impacts for us. Having said that, our strategy has to be stay very agile and prepare for all the scenarios. I can share one example is about the supply chain. Right now, because we have a relatively small percentage of revenue outside of China, and we also mainly source our components and ingredients from domestic China. But we are still closely monitoring what's the potential impacts for the components, ingredients, and also our supplier partnership, and then their financial stability. Those we are still monitoring.
And if there is an increase to the price of your products, who wears that? Do you wear that, or does the consumer wear that?
I'm sorry?
If your products become more expensive because you've got to pay more to import certain tools or different beauty products, do you make the product then more expensive to the consumer, or does you take a hit to your margins?
Right now, the impact is relatively small. As I mentioned before, we mainly source the components and ingredients, and our suppliers are mainly in China. We are selling domestically. So the beauty market is globalized and also regionalized.
Mm-hmm. How is the brand faring then within the mainland market? Because we've seen other ones like L'Oreal, for instance, that haven't been doing that well in China in recent quarters. Do you think that you're taking a significantly different approach to a business like that?
As I mentioned before, we are heavily on where the ball is moving right now. We observe a major shift of the consumer really preferring the tech support with the science and evidence about the product benefits. So we heavily bet on that trend. We invest in the fundamental research, and we publish some very high influential factor articles in Nature Medicine and Science Bulletin. And we heavily bet on biotech and getting some patent ingredients. And then we are also betting on neuroscience, about the neuroscience application in the skincare industry. So those trends, we believe, will be really driving the consumers' willingness to pay. Consumers are happy, and then when they are getting the inspirations about where the next generation of the innovation is coming.
That sort of science-backed approach as well has been an approach that a lot of Korean businesses have taken. Korean businesses, though, also haven't done that well in the mainland market either of late. So do you see any sort of changing preference around customers looking for Chinese brands over ones from abroad?
As I mentioned before, Chinese consumers, they are smart, they're well educated, and they have strong appetite for new innovations. Based on what we observe is when we launch some very innovative products, for example, the Bi-Lip Abstinence lipstick I mentioned before, and also some of the products under Galantic brand, and then like vitamin A, vitamin C serum, those products are really like enjoying the consumer's loyalty. So we go back to chase what is the common thing about behind the consumer's preference shift. They're really looking for next generation innovations. They really want the products which they have never seen before. So that's the fundamental drive we see when they are making the choices. But having said that, I agree with you, after COVID, consumers are getting more sensitive about the value for money. But it doesn't mean low price. They're just looking for higher value.
We spoke to Qin Zhilao, who's the Chief China Equity Strategist at Goldman Sachs earlier, and he was saying something that he's hearing from investors is a big concern around the forced delisting of Chinese companies from US exchanges. And he was saying that maybe you'd see more companies choosing to at least have a secondary listing in Hong Kong as well. But just take a listen to what he said.
We receive a lot of questions about ADR delisting. Right, this is a hot topic right now in the markets. And I would say, if you look at what has happened over the past 2 or 3 years, many pure ADRs have come back to Hong Kong for dual listing or secondary listings. So they're better prepared for some further decoupling risks between the two nations.
So what Qin was also saying there is that one of the additional concerns is that the most pressure is being felt by companies that only have a singular listing in the US. How are you evaluating this risk as well?
We are aware of the news and also the market turbulence. We finished a $200 million buyback program in the past few years. That shows our strong commitment. Because being a public entity gives us the very strong desire to operate disciplinedly. And then we improve our transparency and the corporate governance. And it's also a very strong vehicle for us for fundraising and for future M&A opportunity. But having said that, given the uncertainty market, we have to consider all the possible solutions for us.
Possible solutions, you mean you're evaluating a secondary listing here in Hong Kong?
We are open, we stay open-minded, and we are open for all the options. We need more time to evaluate what's the pros and cons of each option for us.
Okay, David, thanks very much for your time this morning. That was David Huang there. He's the Yatsen CEO, David.
Thank you so much.
Right, fantastic. Looks like potentially we have a potential listing here to cover. We'll see if we get more details on that. Fantastic there with David Huang with Bell there. As that conversation was taking place, we're moving into the 17-minute mark here. Cash markets, and we are near session lows, if not at session lows, 4,800 now in the Hang Seng Tech Index. So these losses are, in fact, accelerating as I speak. Now, maybe part and parcel to that story is this next page with Asia's semiconductor stocks underperforming by, last we checked, a factor of 3 now, if not a factor of 3, 3.5, even 4 in some cases. You'll see the benchmark in a moment. 2 to 5% here. This is the Nvidia story playing out. Welcome back. You're watching the China Show. President Trump is calling on China to reach out to him for talks aimed at resolving this escalating trade fight. But a former top Chinese official says Beijing will only engage in talks if with Washington, if U.S. leaders show some respect. Former Chinese Vice Minister of Finance Guangyao spoke exclusively with Bloomberg on President Xi's three main principles for dealing with Washington.
I think for this specific negotiation should be based on real instruction by two presidents. President Xi highly emphasized the relation with the United States. President Xi always emphasized based on three principles: mutual respect, coexist, and win-win situation to develop a healthy, stable, and sustainable relationship with the United States. That's China's policy. That's President Xi gave clear instruction to all level of Chinese staffs. That's based on that. I was before to deal with U.S. in economic. We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because we don't want the whole world return to the jungle of jungle law.
So just to be clear, right now the two sides are not on speaking terms. Officials on two sides are not discussing possible solutions to the trade war. Is that correct?
That's subject to how do you define that. If that's U.S. want China totally accept the U.S. proposal, to accept U.S. conditionality, I think that's no negotiation, and must be under the mutual respect and with this joint win-win situation.
What does mutual respect look like? Would the U.S. have to reduce the tariffs to 85%, 60% to bring President Xi Jinping to negotiations?
I know in U.S. team always think the President Trump is the top negotiators. Art of Deal, the book written by President Trump, and let's do business. Now it's country-to-country relations. We should exactly follow the rule of WTO to deal with bilateral trade dispute rather than to use just pressure. Since People's Republic of China founded, China never yield to outside pressure. So that's why I hope real negotiation for trade imbalance issue should be based on mutual respect, not just use as pressure and let this other side accept all conditionality raised by U.S. That's impossible.
That was China's former Deputy Finance Minister Guangyao speaking exclusively with Insight anchor Haslinda Ramin. Wow. All right, executives at the biggest trade fair in China, that's the Canton Fair, of course, are finding themselves facing a very cloudy outlook for global commerce. That's as fears grow over US-China decoupling. Our senior Chinese economy and government reporter, James Mager, joins us from Guangzhou. And James, I'm really interested to understand the sentiment that you're hearing on the ground, because I remember at Canton fairs of even recent years, there was the risk of tariffs, but still people felt like the products on offer and the prices on offer made China a compelling place to buy from. Is that still the sentiment, or have things shifted?
I think you have to split Chinese trade into two blocks now. The first is the 15+% of exports that go to the US. And for those people, it really was the few people we spoke to yesterday who were buying to send to the U.S. It really did seem like there's no price that's cheap enough for them to take that tariff hit. But for the other, the vast majority of Chinese exports which don't go to the U.S. even indirectly, the people we spoke to, buyers from Pakistan, from the Middle East, from Africa, from Japan, from South Korea. These people, these people from countries which haven't put these kinds of tariffs on China. And so they're saying still, these products are great prices. And even people we spoke to were saying they were hoping for better deals, because if their suppliers can't sell to America anymore, they'll be looking to they'll maybe be willing to budge on price so that for shipments to South Asia or to Europe and to other places. Depending on where the people are from, it really was it did sort of split into these two camps. But for people who are trying to ship to America from China now, it really is either they've just stopped and they're waiting until see where the final landing point is for these tariffs, or they're very quickly trying to find other markets for the goods that are basically no longer able to be sent to America.
Well, let's talk about a silver lining, some of the green shoots potentially. I mean, it is if not the most important trade relationship in the world, and you add the proxies, Vietnam, Mexico, and some of the other channels with which you do get to see Chinese goods go into the U.S. What about other channels? To your point there, James, are people actively now seeking out new export markets and new trade links? Is what I want to get to.
I mean, certainly companies in China and also their customers are quickly trying to build up their ability to produce in Southeast Asia, especially for shipment to America. And the freeze and tariffs that you saw on Vietnam, on Thailand, and Malaysia has only accelerated that trend. I mean, we're already seeing that from the first trade war in 2018, 2019, and that has continued. And people we spoke to yesterday were saying they're setting up factories to make fridges or increase their capacity to make fridges and other white goods in Vietnam or Malaysia. And hopefully in 6 months' time, they'll be able to restart shipments from there to the U.S. So there is definitely that sort of shift to take advantage of those places which, at least for the moment, don't have high U.S. tariffs on them, to get some Chinese goods or goods made with Chinese components to the U.S. But people are looking for other markets, and other markets are growing. The U.S. market is growing, but other markets are still growing. At least at the moment, we're not seeing a global recession, and so people are looking to shift their exports to other places as well.
Okay, well, let's end on that note, and let's hope we don't get into a recession. James Mager in Guangzhou for us. Plenty more ahead. This is The China Show. Welcome back. So we're just about an hour into this briefing taking place in Beijing, National Bureau of Statistics, after they released data which beat just about across the board. Markets are going the opposite way. There's the Nvidia story that's taking place. We're going into as well a long weekend at some point. So there's very little reason at this point in time to take additional risk, if you will, going into a prolonged weekend where anything could really happen. So that's just about it from us here. We're down about 2%. We'll see you all tomorrow. Plenty more ahead, though, on Bloomberg Television.